We're going to continue this, though, because now we're going to bring into the stream, we've got Joseph Minarik, the Conference Board Chief Policy Economist and former OMB Chief Economist under President Clinton, and then Lindsey Piegza, who is Stifel's Chief Economist. Lindsey, let me start with you. We heard from Raphael Bostic, a voting member of the FOMC, back a week ago when he said, quote, "I'm comfortable letting the economy run hot." Is the economy running hot? Has the Fed signaled that, or we still got to turn up the temperature?
No, I think the Fed was very clear that the economy has taken steps in the right direction. Looking at the statement, they used the language regarding economic activity, employment has turned up. But they also acknowledged that some of the hardest hit industries as a result of the pandemic are still reeling under the pressure of a closed economy, or at least a partially closed economy. So I think at this point, the Fed is signaling that we are taking steps in the right direction. That being said, to Bostic's point, the Fed is willing to remain on the sideline longer than I think the market anticipates, should the economy gain momentum and move closer to that accelerated level, or an economy that one would assume to be running hot.
Joseph, you pointed out that FOMC watchers are looking for the hint of inflation concern. They got that, but the policymakers are in a tight balancing act. As an investor, should I pay attention to not only the fact that they've moved their inflation prediction and the potential for a rate, inflation up, but a rate increase sooner? Should I take that as, well, how should I interpret that? Because it's not going to happen quickly.
It's not going to happen quickly. We are going to see, as you know, strong growth this year, with the problem that with that strong growth, we are going to have a significant share of the U.S. labor force left behind. The folks who were working in the service industries, the hospitality firms, who are out of the labor force or are unemployed for the long term without a prospect of getting back, are going to continue to show slack in the labor market. The Federal Reserve is going to be under pressure to respond to that slack, but at the same time, we're seeing a rapid increase in the GDP numbers. And so with that, quite possibly commodity costs beginning to increase, interest rates beginning to rise somewhat, and they are being caught in a vice.
Lindsey, I'm going to throw this part of what he just said at you. If they're caught in a vice and they're expecting GDP growth this year, 6.5%, and unemployment to be 4.5%, are they overly optimistic?
No, they aren't. And I don't think they're caught in a vice really at all. I think it's very clear that the Fed is responding to current conditions. After all, we did just get another $1.9 trillion in stimulus, with the government touting the idea of trillions more coming down the pipeline. That short-term blip of stimulus, of dollars flooding into the market, will absolutely lift the growth profile near term. But the Fed is also looking at the medium growth term and the longer growth term, where the economy is still going to struggle to get back to some sort of sustainable organic activity level. So the Fed is not going to quickly respond to this artificial bump up in activity as a result of fiscal stimulus. When looking at inflation, the Fed is also not going to respond in terms of a change in policy to this temporary bump up in prices as a result of a reflation scenario, or lower lows of 2020 falling out of the annual calculation. So the Fed is taking a pretty long-term view at the recovery pathway. And right now they're saying, yes, we're taking steps in the right direction. There will be volatility both on the growth and inflation front, but it doesn't make sense for them to adjust, at least in their perspective. It doesn't make sense to adjust monetary policy or rates at this point.
And Joseph, when we talk about that 6.5% GDP expectation, you actually have said that we appear headed to an unsatisfying economic recovery and expansion. Explain why you hold that view. Every other guest I've had on this program has said, wow, gangbusters in the second half. That's not exactly what you're saying.
I think the notion that we are seeing rapid growth now is, of course, that's a reality. Growth will slow after the temporary bump up, in part because of the additional coronavirus legislation. At that time, though, we are going to have left behind, a large number of unemployed persons who are going to have a very hard time getting back to work so long as the virus lingers and so long as the businesses that lost their place in the economy in the pandemic remain shut down. So, at one and the same time, we are seeing for the near term relatively rapid economic growth. It is going to fall back to its potential rate of growth, but as it falls back there, we are still going to have a large number of unemployed persons left on the beach. Employment is down about 4 million, and we have about another 4 million people out of the labor force because of the pandemic. And so we've got about 8 million people we would want to accommodate to get back where we started. And that's going to be very hard to do in an environment where people are still cautious about the idea of going back and using those service industries, retail, dining, hospitality.
Joseph and Lindsey, I just want to put you both on standby. We're waiting for Jay Powell to begin, and that's going to happen any moment. But Lindsey, let me ask you, when you said in a recent note that the Fed is possibly, in regards to the 10-year yield and the bond vigilantes, if prolonged and perceived as disorderly, the interest rate or the yield increase, what's the time horizon, do you think, for the Fed to determine if this is disorderly? Because volatility is something that the bond vigilantes seem to like.
Well, that's a great question. And I do suspect that that's something that's going to be posed to the chairman as we await this press conference. We would like to understand a better sense of what is perceived as disorderly. And if it is perceived as disorderly, what the Fed plans to do about controlling the volatility in the longer end of the market. So this is something that we're going to have to wait and see if Chair Powell addresses. I imagine that he is going to dance around the idea that they continue to watch the market. They're going to watch for disorderly volatility, but really give us no specifics in terms of what determines that disorderly reaction or a timeline for responding to it.